So this is everything I think you need to know about Alibaba coming into 2024. So 2 months in, the stock is flat, my wallet is flat, and everyone's expectations are flat too. So I'll cover why Alibaba's earnings don't matter in the short term, what are the current consensus or expectations over Alibaba's execution, a hit piece from Financial Times on why Alibaba essentially sucks, and share my framework on why I'm still holding on to Alibaba, even though it seems like it's an insane move considering all the risks involved. So before we start, I thought it was interesting to first provide context around US versus Chinese equities today. So I've stolen a simple infographic created by a friend, Bunti. So he basically compared the market capitalization of the most prominent US stock till date, Nvidia, benchmarking it against the top Chinese companies weighted by market capitalization. So to no one's surprise, Nvidia is worth more than the top 11 listed Chinese companies combined. Of course, I'm already sensing some of you loading your bullets, preparing to attack us. But hold your horses. This is just a matter of fact, whether you like it or not. So I'm not trying to draw any particular conclusions from here, but I think it's an interesting milestone to look back sometime later. Let's see how this entire thing will play out. Now, let's focus back to Alibaba. So in a recent interview on CNBC with an analyst from Barclays, he made the assertion that Alibaba's results don't matter that much.
I think Baba is clearly in a bad neighborhood. The whole entire Chinese ADR seems to be a pretty bad neighborhood. I actually don't think that today's results matter that much. I think there's three things that have come to my mind that have a either positive or negative impact on the stock. But without doubt, Alibaba is trading 2 times the EBITDA, 2 times the free cash flow if you take all the cash, when some of the largest US tech names are trading at 30 times free cash flow with very limited growth as well. So the three things that have moved the stock today, one on the positive side, I think they upsized the share buyback program to 35 billion now. They added another 25 billion to it. But there are two other things that may have a negative impact on the stock. I think that's why the stock is down 6%. The first thing is that they kind of pivoted away from the whole value unlocking IPOs or spin-offs, which they just laid out not that long ago. It was like a year ago. Now they're no longer doing the IPOs for the time being for Cainiao and Hema. They canceled the IPO, as you know, last time. For the cloud, I think investors sort of feel disappointed by that. And the second thing, maybe negative for the stock, is that the company is pivoting to growth, but potentially at the expense of the margins.
So I think what he outlined pretty much explains how most people are playing the stock right now. So everyone is looking for the next big catalyst that will push the stock price. Whether is it via a spin-off, an IPO, a massive share buyback, some never seen before stimulus, etc, etc. You get my point. Not many people are actually bothered whether Alibaba is going to be bigger, stronger, more profitable 10 years from now. In fact, when they said that they wanted to refocus on growth, not many investors were excited. And most investors would think that it would be value disrupting, because that means that, hey, lesser cash will be returned to shareholders in the short term. So there's no compelling story, and everyone is waiting for the next big wave up so that most of you can probably cash out. So I guess that's essentially the psychological state of the investor base today. So I've recently received my cash voucher of $120 worth from participating in the previous Moneybull campaign. And I'm happy to share that Webull have not only extended this Moneybull campaign, but they have also upsized it. So at the highest tier right now, you can potentially get up to $5,000 worth of rewards. So for those of you who have missed it the previous round, now is the time. Now, you just have to fulfill 2 key steps. First, tap on participate now and activate or subscribe at least $2,000 worth to Moneybull during the campaign period. Second, meet the following requirements during the campaign period and make sure you maintain these requirements during the holding period, and you will receive the Nvidia shares reward incrementally. So the rewards are awarded in 6 batches, and it must be claimed under the My Rewards page in the app within 30 calendar days. So for those of you who are actually worried about foreign exchange risks regarding converting between the Singapore dollars to the US dollars, You don't have to. So if you subscribe to Moneybull via Singapore dollars, it will be converted based on the following exchange rate. So more information can be found on their terms and condition page, which explains the entire mechanism of this specific campaign. So for those without a Webull account today, I don't know what you're waiting for. Sign up with the link below now. Thank you Webull for sponsoring this video. I think investors are all over the place regarding Alibaba now. So pre-2020, Alibaba was essentially the darling of Wall Street. They were essentially the de facto China proxy, especially to investors that want a piece of that exploding Chinese consumption story. And on top of that, it was seen as the poster child of how foreign investors were able to profit handsomely, even from the so-called communist Chinese market. So the largest beneficiary? SoftBank, with their early $20 million investment in early stage Alibaba back in the year 2000, where their stake was worth more than $200 billion at its peak. So that's a 10,000x. The story of Alibaba was much more than just e-commerce. Not only were they running the largest e-commerce business, they were the leading advertising platform, they had the largest market share in cloud, they were the biggest payment processing platform. They have a huge venture portfolio and they were basically everywhere in China. Now, moving on to recent times, 2020 was the pivotal point when the tech crackdown initiative was in full motion and an IPO marked the entire start of the crackdown. The Chinese property sector was also dealt a huge blow as it underwent massive deleveraging engineered by government policies. So COVID definitely didn't help as well. So the overall economy was chugging along, but with much less vibrancy and dynamism. So the stock market continued to underperform. The government couldn't care less. More policies and regulations are being introduced. More investors are being scarred by their experience in the Chinese equities market. And net, it was a huge loss in confidence in both the Chinese economy and the Chinese stock market. Specifically for Baba, they had to comply with the new regulatory framework and environment, yet at the same time adapt to changes in consumption patterns. So there was a rise in this term called social commerce, where e-commerce is no longer just a commerce activity, but instead a social activity as well. Folks were essentially sharing links, helping each other slash prices, group buy, live stream, and many more. So they were slow to adapt, which allowed for Pinduoduo and Douyin to carve out a niche of their own. And Alibaba went through the last 3 years with not much to show. They wanted to empower the individual business units, hence adapting the 1+6+N strategy, but results seems to be mixed, at least for now. There was also an unexpected leadership transition. So Daniel Zhang, who's the ex-CEO, wasn't able to deliver for the last 2.5 years. They had listing plans and they called it off. To sum it all up in one word, messy. And it's turbulent times for the company, to say the least. So to add fuel to the fire, Financial Times has also recently published a hit piece on Alibaba right on Valentine's Day, further cementing the impression that Alibaba has lost its way. And a perfect title to sum it all up. Alibaba gives way to China commerce rivals on Jack Ma Boulevard. A simple summary would be that Alibaba's platform has lost its magic. Merchants are no longer loyal and pledging allegiance to only one platform. So in their survey, more than half dozen merchants said that Chinese shoppers' behaviors have essentially changed, with buying across platforms the new normal, forcing them to follow suit and also open online stores elsewhere to essentially keep up to competition. When looking at an overall market share trend, Alibaba used to have more than 60% of the e-commerce market share back in 2019. But in the latest quarter, this number is much closer to 40%. And that's a 1/3 shave off in terms of market share. And with rivals such as Douyin and Kuaishou participating in the e-commerce scene much more aggressively compared to 3 years ago. So I found several observations rather interesting. For those of you that actually do follow the Chinese tech scene, we have seen that Pinduoduo has essentially been smashing records after records, with astronomical growth being posted. However, if you look at this piece of data point from Bernstein Research, Pinduoduo's local e-commerce market share seems to be hovering at the same spot since Q1 of 2021, albeit fluctuating from quarter to quarter. Definitely not warranting those superbly high double-digit growth rates, sometimes in the 80 or 90%. So Pinduoduo's growth is potentially driven mostly from their US expansion and not so much of their foothold in China. Second, dominating a hyper-scaling market at 60% market share is a pipe dream. Even Amazon in the United States are doing similar numbers at right around 40% of the US e-commerce market share. So expecting Alibaba to maintain at 60%, I think it's a tall order. Third, I think the market share only tells one part of the story, and the closest that I could get at for the second half of the story would be Alibaba's GMV figures. And it seems like they're still in a rather healthy trajectory moving forward, although it definitely don't feel good losing market share. So an anecdote from a merchant from these e-commerce platforms lamented that, and I quote, Ali people didn't care about us at all, which is a total different support system Pinduoduo offered to the merchants, unquote. That said, he only viewed Pinduoduo's volumes as sufficient to keep his factories humming, while his profits actually came from selling higher margin goods on Taobao and JD.com. Essentially, he cannot count on any single platform and he needs to be diversified. So I think it's fairly intuitive for merchants to want to get the maximum exposure, hence opening their shops everywhere. I mean, if you're not seen, you're not selling products. But it's always about the economics of the business and achieving a win-win between the different parties. So another factory owner also said that Pinduoduo has lots of traffic, so we don't need to buy so many advertisements. But they are never able to extract margins from that particular platform. On a similar note, another merchant said that, and I quote, traffic is declining on Taobao and Tmall. That's true. But that is also where the best customers are at. At Alibaba's peak, about 30% of the traffic to his online stores are free. But now, it's 15% at most. And he pays for the rest by buying adverts, unquote. So it then goes back to the question. The mode of an e-commerce platform is dependent on who has the best ability to meet the varying business objectives. Awareness, turnover, scale, and of course, last but not least, profits. So the question of the century, what does it take for Alibaba to turn things around? So I think by now, you probably have realized that it's not a bed of roses for Baba too. Not everything is explained by geopolitics and China. Sure, they do play a role in terms of the storyline and how the narrative is being building, but Alibaba's outlook, execution, and financial numbers are not performing as well as they could either. So long story short, they're slowly losing their lead. On that note, late last year, on the 29th of November 2023, Jack Ma actually praised their rival Pinduoduo in an internal memo, while at the same time urging Alibaba to correct course. So I'd like to take the time to correct you too if you still haven't smashed the like button. Please make sure you're on the right course. So where do we go from here? Recently, I think there are a few positive developments around the stock. Positive, living in air quotes here, because we can't really confirm and they are basically just guesses. So Jack Ma and Zhou Cai, both early co-founders and iconic figures of the company, has decided to buy $200 million worth of shares as a signal for confidence. So investors sell for many reasons, and we buy for only one, because we expect them to go much higher in the distant future. So in their recent earnings, they have also painted a picture of Alibaba shares acting like some sort of a bond that has a minimum 4.5% yield if bought at current prices, due to the share buyback program and also the dividend issuance. So if you want more details regarding this bond-like structure proposition, I've made a video on that. If you're buying at current prices, the margin of safety is incredible, but you probably can't expect a V-shaped recovery like their American counterparts, unless something seismic actually do happen. So similar to the Barclays analysts, I do think that Baba has one of the best risk-reward payout because our downside is pretty much capped if the company is pledging publicly that the lowest return is a bond-like yield. So unless the management team walk back on their words and investors don't trust them, which by extension they can sell down the stock by short selling it as a vote of no confidence, I don't think we see a huge downside from here, considering the valuations they are currently trading at. So the biggest risk in this case is probably opportunity cost, as many investors are probably looking at multiplying their capital in a short span of time. So if things do normalize, I do think that Baba is an easy double.
Have been saying, despite I made some sort of comments highlight the risks, we have seen Baba is one of the best risk-reward stock maybe anywhere in the world. It's definitely the cheapest tech stock anywhere in the world. No matter how you look at it, even if you give zero value to everything they own, including the cloud, which generates $15 billion revenue a year, the biggest in China, in Asia rather, the third largest in the world. Even if you give zero value to all of the subsidiaries, Baba is trading like 2 to 3 times free cash flow. So the valuation proposition is just so compelling now. But because of some of the pivot, I noted earlier, now investors are missing the catalysts. They were waiting for the IPOs as a catalyst. Now it's kind of moving from catalyst to kind of grind. They now need to grow their core business now for both Taobao and Tmall, some of the and the cloud, and that's not going to be easy overnight.
So yes, Alibaba might not be the highest quality company out there, but if you do a risk-adjusted return, meaning if you consider the downside risk, considering the story, considering the expectations being built into it, adjusting the different factors, I'm still extremely bullish behind this company. So from a quality perspective, Baba's new management has a lot to prove to shareholders. So execution has been lackluster over the last 3 years. Communication and trust is not the best. So even if we were to compare Baba pre-2020 versus right now in 2024, they have indeed been losing market share, but they're still first in e-commerce, first in cloud, first in payments, and even the newest and hottest thing, first in large language model, at least based on their disclosure. So like many past conglomerates that lost their magic, for example IBM, it takes time for their moat to erode. So at their core, at Alibaba's core, they're an internet and tech company. So that's great potential to be unleashed here, but they've yet to deliver. And potential can only be converted to cash flow and profits if it's unlocked. So for now, many of us are still judging them based on their e-commerce business, and time is indeed running out. So patience is running thin, and there is a limit of how many benefit of doubts investors are willing to give. In today's context, there are very low expectations that are priced into the valuation. All things considered, I do think that the odds are in the company's favor in 2024. So feel free to leave in the comment section down below on what you think of Baba in 2024, and I'll see you in the next video, but more importantly, I'll finally see you on the moon. Goodbye.